Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about something that I saw in The Wealthy Barber as I was rereading the book this past weekend, and that is your PITA factor. And so what is a PITA factor? A PITA factor is a pain in the factor. What is the pain that your investments, your financial plan, your retirement world is causing you? And I think a lot of you are much higher on the scale than you maybe think you are. So let's go through the 7 steps, figure out where you stand, and then at the end of the video, I'm going to go through some solutions, some tips and tricks to how do you lower that PITA factor? I think a lot of you have put a blind eye to this, and most of you I talked to, you've kind of ignored your investments, and a lot of us are this way, right? I'm good at doing this over here, my career. I make good money at it. I'm good at it. That's my focus, and there's nothing wrong with that. But you've built up a little nest egg over here, or a big nest egg for some of you, and you kind of just leave it to someone else, and the trust is, it is what it is, and it's just there. And I think a lot of you need to kind of refocus over here and figure out what's going on over here. So the first thing we look at is, are you investing sexy but not getting the returns? And what I mean by that is a lot of you are DIY investors, which is great. I have no problem with that. But a lot of you are buying these sexy names out there, right? Especially the last 2 years, tech names have gone big, Bitcoin, cryptocurrency, whatever it is. And they're really not working out for you. You know, a lot of you have hit a home run on Tesla, a Shopify. You know, I have a client that bought Shopify at $50. It's now, what was it? Thousands of dollars. But again, a lot of you now got into these stocks a bit later. Shopify is a good one where you maybe lost 50% of your money now. If you're investing, a DIY investor, what's your strategy? And are you just chasing sexy names and the overall return isn't there? The second one is, are you watching your investment gains on a daily basis? Are you logging in every single day and worrying about it or looking at it? And I talked to a lot of you and it's like, yeah, I log in every day, but I don't worry about it. Then why are you logging in every day? Do you log into your bank account every day just to make sure the money's there? There's lots of things that we need to do every day. Brush your teeth, have a shower, lots of stuff. Checking your investments is not one of them. If you're a DIY investor, you should be going into your investment accounts either when you need to make a transaction, or if you know there's maybe earnings calls or something coming up on a stock that you own. Absolutely. But in general terms, you should be logging into your account no more than once a week. If you have your money professionally managed, it should be at once a month. That should be at most you need to go into. Again, you've hired professionals to look after your account. Let them do their job. The third one is where a lot of you fall if you're not a DIY investor, and that's high fees, low value. This comes across my plate every single day. I had a few clients yesterday I had phone calls with, and we're talking $5 to $10 million of assets, and their fees are way up here, and what they're getting is way down here. And these are through large financial institutions. They're paying for the investing side, the planning side, the this, the that, the other thing. They're spending tens of thousands, some of them hundreds of thousands of dollars in fees every year. And when I ask, they're getting nothing in return. They're in mutual funds. They're getting no planning, no tax planning, no estate planning, no nothing. If you're paying a high fee and getting high value, then you have to look, is it worth it? But if you're paying a high fee and you're getting no value or very low value, to me, that's the biggest PITA factor. If you have under $1 million, let's just call it 2%. If you're over $1 million, you should be 1.5%. Over 5 million, you should be under 1%. That's kind of the general rule there. Talk to some professionals, interview some more people, find a better solution than what you're currently sitting in. The next one is typically where the last one goes to. I was paying high fees and getting no value, so now I'm paying low fees but getting no value. So make sure you don't fall into that trap, okay? Don't just jump into a low cost, whatever it is, ETF, online, whatever it is. So yeah, I'm paying low fees now, but you're still getting nothing. You can pay a moderate to low fee and get value. You have to do your due diligence, interview some advisors, whatever you're looking for. You have to look at the tax planning, the estate planning, the retirement planning. If you're getting close to retirement and you're a DIY investor, you're taking care of one piece of the pie. The other part of it, and what you should be paying a fee for, is the planning, the tax planning, estate planning. That saves you hundreds of thousands. Yesterday I did a plan for someone, I saved them $1.33 million. That's a huge amount of tax that comes back in their pocket and not to CRA, or maybe to the loved ones or charity or whatever it is. The next one is you're paying good fees, you're happy with your fees, but the performance is really bad. I think a lot of this happens with active portfolio managers. Again, if the portfolio manager is underperforming, but you're getting really good value maybe through a financial planner, maybe it offsets itself. But if you're paying a reasonable fee, but getting really bad returns and not a lot of value, there needs to be an adjustment there. I always say 80% of active managers underperform the market, but that means that 20% do better than the market. They're worth the fee that you pay them. Typically, of that 20%, it's the same 20%, or a large basket of that is the same 20% year over year over year. So if you find a really good portfolio manager, typically, not always, but typically, they will consistently outperform the market. The sixth one you want to look at, and again, this is a big factor for me. So when I look at investment firms to partner with for our clients, the biggest thing I need is transparency. I need full transparency for fees, what I own, structure, ownership, everything across the board. And in the investing world, it's definitely not usually like that. There's hidden fees. You don't know everything that you own. I've met financial advisors. I've worked with financial advisors that own shares of the investment company they're referring clients to. To me, that is lack of transparency completely. And they may disclose, hey, I own some shares here, but it's in fine print at the bottom of an engagement letter. That is absolutely wrong. This is the problem I always have with banks. The banks sell you bank products. I think there's a lack of transparency and accountability there. One of the firms that I partner with, we're my own money. So my own money, I have my money, my personal and my corporate assets invested at BCB Asset Management. They're a firm that we work with quite extensively. I've worked with them for over 10 years. I don't own a single piece of their business. They don't own a single piece of mine. But what I like about BCB is that they show their transparency. You know exactly what you paid. You know what you own. Every single stock, how many shares, dividends coming in, everything. The third thing I love is that every transaction they do in my account or for our clients, you get a notice of here's what we sold and here's what we bought. And here's why we sold what we sold, and here's why we bought what we bought. And I've never seen an investment firm do that other than BCB. And the last thing to qualify where you fall into the scale of on the PITA factor is, are your investments a black box? And another term for that is, are your investments in mutual funds? Now, again, if you have under 250, 500,000, mutual funds or maybe an ETF is the best option to go. But once you hit over that 500,000 mark, there's access to private investment firms, individual stock ownership. There's just a better investment option out there. So if you're sitting there with a fair amount of money and you're sitting in mutual funds and you have no idea what you own, because mutual funds really are a black box. It's hard to know what you own, transactions in there. You may want to revisit that. Find where you are on this graph. I assume most of you are on the 7 to 10 scale. I want to get you down to that 0 to 2. So go through those 7 steps that I went through and see what boxes you check off. I'm paying high fees, I'm getting no value. I need to talk to my advisor. Maybe there's value that my advisor offers. I just haven't kind of dug into that. And I think that happens quite a bit. So start with that. Figure out what you need to kind of get lower on the scale and start making steps. Now, what are those steps? Let's go through a few of them. I want to cover two main ones. And that is, first off, simplify. A lot of us have complicated our world. We have investments in many different places, or we've kind of left it all up to one person. We don't dig into it enough, or we dig into it too often. Figure out, where is a good home for me? Where do I feel comfortable? Where am I getting advice? Where am I getting planning? Where am I saving fees, taxes, estate, all of that kind of stuff? Okay, and when I say simplify, really where I'm leaning towards is, if you're doing it yourself and it's driving you crazy, hire someone to do it. Sometimes paying a fee for something makes sense, right? It's like the guy next door that cuts his own hair. It's like, dude, you need to go pay the $20 and get the hair cut by a professional. The other thing is have a plan. Too many people I talk to on a daily basis have no plan. Take a step back, get a plan in place. Maybe the advisor you're currently working with, they offer that service. Reach out to them, see if they do, see what the cost is, structures, all of that kind of stuff. And then if you don't work with an advisor, a lot of you are DIY, reach out to an advisor, get a plan in place. These plans make sense. They save a ton of money in tax. They create structure. They give you the GPS map. I always say, too many of us think of retirement in silos. And I've talked about this on the channel before, where you have your RSP and your TFSA and your pension and your CPP and your OAS, and you kind of figure out what you take from each one. At the end of the day, it has to come together in a comprehensive plan. And if it doesn't, you're paying way too much tax. You're not going to pass as much as you can to your loved ones, charity, whoever you want to pass money to, and you're not going to maximize your income in retirement. And the fourth one, and my biggest fear for you, is that you're going to get to later in retirement, in your 80s, 90s, you're not going to be able to do the things you want to do anymore, and you're going to look back to your 50s, 60s, 70s where you could have enjoyed that money better, and you didn't because you didn't have a plan, and now you're going to pass away with way too much money, and too much of it's going to go to CRA in the form of taxes. So create a plan, simplify your life, and get your PITA score way lower than it is. You're way up here. We need to get down here, you guys. So thank you for watching the video. If you haven't subscribed to the channel, hit subscribe below. Cost you nothing. Take you 1 second. We do appreciate it. We'll see you in the next video.